Hello, chart watchers, and welcome to this Wednesday, June 20th Market Watchers live show with your hosts, Tom Bowley and Erin Swenlin. For those of you joining us for the first time today, welcome to the show. And for our regulars, welcome back. Well, we got another interesting day in the market after gapping down each of the last couple of days and trying to rally back on the Dow and S&P 500. Today, we actually gapped higher on the Dow, started the day in positive territory, but you can see it's actually reversed heading lower. So the downtrend that we have seen over the past 6-7 trading days on the Dow Jones continues as we move closer and closer to that late May price support area. The S&P 500 did gap up after a couple of kick saves the past 2 days. You can see these hollow candles after gap downs at the open. We did rally and finish near highs of the day. We've gapped up today, up 8 points. So you can see it is a bifurcated market. The Dow down 31, the S&P up 8. The NASDAQ up 64 points, breaking out to a new all-time high. The Russell 2000 up another 12 points, also breaking to a new all-time high and above 1,700 for the first time. The 10-year Treasury yield is bouncing after moving lower over the past 4 or 5 trading sessions since the Fed raised interest rates. We are now back moving higher, putting in a higher high. So it does look like the TNX trying to end the recent slide in yields. The volatility index, after a big gap up yesterday morning on the opening weakness, has continually moved lower. We are off of the lows from earlier today, but still the VIX down almost 6% today. Consumer discretionary continues its move to the upside, breaking to another high. Technology not breaking to a high, but remaining in a very bullish flag formation, looking for a breakout there, a little above 72. The internet index is leading technology today. You can see a huge move up. Well up above the recent highs, and restaurants from the consumer discretionary space actually struggling today. You can see the restaurants down about 3%, 43 points. Primary reason, Starbucks. They lowered their guidance for Q3 and for fiscal year 2018. And as a result, Starbucks down 8.5% today. Oracle reported earnings. The earnings actually came in better than expected, but their guidance was weak. And you can see Oracle also down 7.5%. Okay, Erin, happy Wednesday. We got another big show lined up. How are you doing today?
I am doing well. Have you not been going to Starbucks anymore? Is that part of their problem right now?
Well, I had my golf weekend. I missed Sunday. So they didn't see me. They lowered their forecast. I apologized this morning when I went in, told them that I would make up for it. But for now, Starbucks taking it on the chin.
Absolutely, it is. I'm doing great. Beautiful weather. We haven't had it doesn't get too hot here right now so far. So just, I might actually even I'm thinking about a trip to Disneyland to visit my cousin who's there for dinner tonight. So I guess, how am I celebrating Wednesday? I'm going to Disneyland.
There you go. It wasn't that long ago. I was whining and complaining about the cold weather here in the Southeast. We had a really late spring. So it was really chilly and wet and so forth throughout the early spring. Well, that ended. That is definitely ended. 3 days, it was up near 100 degrees. I had a feeling we were going to have a short spring, and we certainly did. But we are moving into summertime, and the heat is here on the East Coast for sure.
Yep. We'll be getting there soon, I'm sure.
Yep. We do have a special guest with us, though. So let me bring in Grayson Roze. Grayson, how are you doing today?
I'm good, guys. Hey, Tom, I gotta give you credit. I liked your kick save comment there. Your hockey references.
Yeah, I did that little hockey reference, and then also I guess maybe a little bit of throwing a little World Cup too, right?
Yeah, there you go.
I know you're with us today, not providing us tips and tricks at stock charts, but actually going through and giving us some rules, maybe to follow to better trading results. Is that correct?
That is correct. Yeah, we're going to get into that in just a couple minutes, but I'm here to do something a little bit different, not the standard stock charts, everything stock chart segment. So should be fun.
Yeah, it should definitely be fun. I know we're all looking forward to that. Erin, why don't you take it away? We'll go through the upcoming schedule and the agenda and get everything started here.
All right, let's do that. So tomorrow we do have Julius de Kempener here. He is Mr. RRG, so I'm sure he'll have some very interesting information based on those charts. We will be doing Anatomy of a Trade on Friday, so you won't want to miss that, as well as Tom's workshop. That's next week on Tuesday. Have you got a title yet?
Of course not.
Of course not. Right after that on Wednesday, we do have Scott Carney from the Harmonic Trader. So that should be interesting. We've had him on before. And then on Thursday, we have Dan Russo from Chaikin Analytics. He does that power feed in the mornings. Hopefully you've caught that on Stock Charts TV. As for today, we're going to start off, of course, with Grayson Roze after our technical news. And the 10 and 10 to 1, our first symbol is going to be Constellation Brands, STZ. So stick around for that. Go ahead and look at the chart. And finally, we're going to finish with a new segment called Watch List. And we'll talk about that more when we get there. So let's go ahead and get into those technical headlines and news. What's going on, Tom?
All right. Well, we do have some economic news out, a little bit of economic news out this morning. We had the May existing home sales came in at 5,430,000 units. Unfortunately, it was less than the market was expecting, which was 5,500,000 units. I know home construction stocks were down on the news, one of the weakest areas in consumer discretionary again today. The 10-year Treasury yield, though, did respond positively. Maybe it's just a little bit of a bounce off of the recent weakness in the yield. A lot of money has been rotating into the treasuries. And I thought maybe what I would do is just point out on the TLT. Actually, maybe the best way to do it, I did write about the TLT. I've already got an annotated chart in my blog from this morning. So let's take a look at this. The TLT, you can see that for a while, when we were moving higher as we headed toward the end of the year, each time we pulled back, we had this pretty wide support zone on the TLT between roughly 119.75 on the low, which was last July's low. And then you can also see a multiple number of lows in this range between 119.75 all the way up to about 122.25. But once that broke to the downside on the TLT, look at the volume really accelerate. I think this is a change of character in the chart of the TLT. And this was coinciding, of course, with the Treasury yields rising. So Treasury prices go down when yields are moving higher. After we broke down, we have now been moving into this 119.75 to 122.25 resistance zone. So where before this area was providing great support for the TLT, now it's creating a lot of headwinds, overhead headwinds on the TLT. So this is something that I would watch. I expect that we're going to see the TLT move back down from this resistance zone. The Fed's been telling us that rates are going higher. The Fed's been telling us our economy is strengthening. TLT should not be going up in that sort of an environment. So if you're in the TLT, you've got to be thinking that maybe what the Fed's been dishing out is not correct. If you click on the chart, one nice feature here is you get the live version so you can see what's taking place. And you can see that we are beginning to move back down. It looks like maybe a little bit of an island reversal after moving up for about 5 or 6 days. Yesterday's candle on the TLT kind of being left up there on a little bit of an island as we move back down. We've seen this before. Here was an island cluster back at the end of May when we moved up to that 122.25. These three candles just kind of in a cluster after a gap up, and then we gapped down, leaving them on an island. That was a reversal. We came back down for a few trading sessions and then made a push back to the upside. So the TLT is definitely worth watching. I do think it's in a key resistance zone, and I fully expect that we will see the 10-year Treasury yield going up while we look at, say, the TLT moving lower. As we look at the market, you can see the Dow Jones Industrial Average really rallying back now, only down 9 points. NASDAQ still up 66. Big breakout there, and now approaching 7,800. The Russell 2000 continues its torrid pace as it continues to break to all-time highs. Let's take a look at some of the sectors now. I mentioned earlier at the top of the show, technology and consumer discretionary leading. That continues to be the case. And the really good news is if you go back and you look over the last month, take a look at what's been leading: consumer discretionary and technology. So as the market's been making this big push to the upside, we are once again being led by riskier areas of the market. And from a bullish perspective, that's exactly what you want to see. You want traders and investors to have a very solid risk appetite. And this is one way of viewing that, with consumer discretionary and technology leading. If we go into the industry summary and look at the consumer discretionary, check out what's leading. Should be no surprise, specialty retailers. This is a group that's been leading for a long time, and they continue to lead. Netflix, certainly one of the key drivers in specialty retailers, but there are others. One I mentioned yesterday on the show and in my blog this morning, Williams-Sonoma, starting to show some pretty significant life. That's WSM. But specialty retailers doing very well. Here is down at the bottom. We talked about home construction, not exactly lighting the stock market on fire at this point, actually going in the wrong direction. Restaurants and bars, because of the Starbucks news, really taking a hit. You can see down almost 3% on the day, and clearly the worst performer in consumer discretionary. As you go down to technology, look at the leader. It's internet. Click on this and you will see internet made a very significant breakout, breaking above the triple top that we saw in 2018. And I think this is just strengthening to the upside. So it's a good thing when you see the internet stocks performing well. And that is exactly what we have right now. So what is lagging? What's been struggling? Why is the Dow struggling? Industrials. You've got a lot of multinationals that do a lot of business throughout the world, especially in China and in Europe. So all of these trade war talks and additional tariffs possibly being imposed really having an impact on these stocks. The other thing that's having an impact is that rising dollar. So long as the dollar remains in an uptrend, stocks, multinational stocks, many of which found in the XLI, are going to struggle. Also, the XLB getting hit by a lot of the tariff talk and trade war. You can see over the past several days, the materials group going down and the industrials going down. And so if you want to know why the Dow Jones isn't keeping pace, well, those are two big reasons. They've been basically pushing the Dow Jones Industrial Average lower over the past 5, 6, 7 trading days. Another area that I really like, I think that's beginning to strengthen, showing a lot of strength of late, broadcasting and entertainment. Big move up. I think the daily chart, after moving lower for several months, looks like a character change to me. Not only have we broken this downtrend line, but on the push to the upside, check out the volume that's been coming in on this move. I think broadcasting and entertainment looks really good. If you see a pullback and you fail to hold the rising 20-day moving average, I'd maybe grow a little bit more cautious, because longer term, we have had some issues in broadcasting and entertainment. As you can see, we actually set the high back in January at a little above 1375, but we are currently trading about where we were, I don't know, maybe a year and a half ago, close to a year and a half ago. So this is a group that hasn't participated to the upside with the overall market, the S&P, the Dow, and NASDAQ and Russell 2000. But you can see June has been very strong so far. And that daily chart that I just showed you, I do think that we're seeing some character change there. So I wouldn't be surprised to see broadcasting continue this move to the upside. Let's see. We have the restaurants and bars. Let's pull it up. It's not a pleasant sight today. Okay, that's broadline retailers. Wrong one. That would be a pleasant sight. Here you've got restaurants and bars. And I really thought things looked pretty good. I mean, here you had a nice move up, flag formation, but technical analysis isn't 100%. We expect to break out. We certainly did not get it, though. And on this push back to the downside now, I think some of these prior support levels come into play. I think 1440 to about 1455 is pretty significant, at least for this short-term uptrend that we've seen since the February low. I think if we fail to hold, I'm going to say 1440, that could bode probably for a triple bottom down here around 1370, 1380. So let's keep an eye on that group. The good news is money is rotating into consumer discretionary. So if restaurants and bars just start to get some of their fair share, they should be able to hang on and not meander all the way back down to the February, March low. FANG stocks. Wow, they've been on fire. Netflix, one of them. This is now a $400 stock. Actually, it was $400. It broke $400 yesterday, now $417 stock. And the other one breaking through a psychological milestone, Facebook. 200 had never been through 200. It is breaking above 200 today. So you got Netflix and Facebook part of the 400-200 club. But I just want to make sure everybody understands, those who may be new to investing and look at these two stocks might think that Netflix is the bigger company because it's a $400 stock. Facebook's a $200 stock. But really, this is a per share basis. You have to multiply that times the number of outstanding shares to come up with the true value of the company. So just to give you some idea, Netflix, which is a $400 plus stock, has a $180 billion market cap. So the market is saying it's worth $180 billion based on the $417 price times the number of outstanding shares. Facebook, on the other hand, $585 billion market cap with the $200 price tag. So there is some differences there. Okay, let's keep moving on. Grayson, I know you've got a great presentation for everybody, so I'm going to turn it over to you. I did want to just mention, I'm sure you saw the news, GE, after a long period of being in the Dow, well, I don't even know how many years, over 100 years that it's been in the Dow, it is being removed. What do you think of that?
What do I think of it? It's like you said. I mean, it's a historic stock. I think it's been in the Dow since 1907. I mean, that's an incredible history of being part of the Dow. It's a big move. It's a really big move.
Yep, it's a changing of the guard. We've had Apple and Microsoft coming in, in recent years, and now you're seeing some of the older companies like GE being removed. It's just a fluid index. Even though you don't see changes very often, they do occur, and this is a big one.
Yeah, no, it is. All
right, so what do you got for us today?
Yeah, I'm back, as we said, with something a little bit different this time. I'm not doing that everything stock chart segment. I'm actually really looking forward to talking to you guys about what I do outside of my role here at Stock Charts. I am an investor. I've been investing for quite a while. So I'm excited to share some stuff with you guys today. I wanted to see if anyone caught my little joke here with the title, 10 for 25. That was my way of referencing the 10 and 10 to 1 segment that you guys do. I thought you were doing that. I'm going to copy you guys. I'm going to do 10 for 25.
Yeah, I thought that might be what that was.
All right, you caught me because I had no idea what it was.
Oh, I knew that would sneak past you, Bully. No, anyways, I'm sort of covering today 10 essential lessons, rules, and strategies from what I'm calling a lifetime of investing. And Tom was joking with me a little bit before the presentation, saying a lifetime of investing, you're only 25. But as I'm going to talk about here in a second, I really started learning about the financial markets and actually looking at charts and starting to buy stocks when I was 10 years old. I know it sounds a little crazy, but it's true. Since then, I've gone on to do a couple things. In addition to being the business manager here at Stock Charts, I've actually written a couple books now. My latest book was Trading for Dummies, which came out last year. But I actually started writing my first investment book in college, and that came out in 2016. It's called Tensile Trading, the 10 Essential Stages of Stock Market Mastery. So there's a little fun tie-in there with the title as well, and the title of my book. Since then, I've gone on to co-found this little investment education company called Stock Market Mastery that I'm doing alongside my father, and through that we teach investment courses together. So it's been a fun project to work on. Anyways, I wanted to give you this background because what I'm trying to say here is that I'm not just the stock charts guy. I'm not the guy who helps put together the charts and work on the the technology behind the scenes. I actually use all of the features on the site. The features that we develop and the things that I sort of, the opinions and ideas that I come up with for features on the site and everything, they're things that I actually go on to use in my own investing. I am trading actively, managing my own money. So that's the point of this. I'm kind of getting the opportunity here to step outside of the stock charts role and talk to you as an investor. So before I really begin, we are going to absolutely fly through today's presentation. I got way too excited about coming on and joining you for this thing. So I got a lot of slides to get through here, but I think we're going to have some fun. So anyways, like I said, my story begins at a pretty young age. I was 10 years old when I started learning about the financial markets. And my story begins with a pink highlighter. It's kind of weird, but bear with me here for a second. As I mentioned, I started learning alongside my father. My father actually has been investing actively, managing his own money for 30 years now, something like that. I think he might have actually just crossed the 30-year mark. So he was teaching investment classes when I was a young kid. And I always wondered, what's dad do for a living? I knew that he was a stock trader. I didn't really know what that meant. And I knew that he was teaching these courses. So at the age of 10, as a demonstration to his class, he actually brought me up on stage in front of 100 people that were taking his courses each semester. And he gave me a pink highlighter, and he put up a chart on the overhead projector. Back then it was an overhead projector. And he said, Grayson, draw trend lines. So at the age of 10, what he taught me to do was draw trend lines with a big pink highlighter on charts. So I had things just like this. He'd put up a chart on Microsoft and he'd say, Grayson, take this big pink highlighter, draw some trend lines across the chart. And so at the age of 10, again, I was doing this very simple investment analysis, financial analysis, investment research, really. And I was making relatively informed decisions about different stocks. What the class would do is they would throw up all these different stocks on the overhead projector, and I would draw trend lines on all of them. And so you'd have these people that were, in their 50s, and they're arguing about, is GE a good stock to buy? And I would come up there and I would say, no, it's going down. Simple. And I was 10 years old. So the important thing that I want to mention here, and the reason that I'm pointing this out, is because my investing started from a very, very simple point. I learned one of the most basic fundamental aspects of technical analysis that everyone starts with, and that's just drawing trend, analyzing trend. And that has invaded the rest of my investing philosophy and the strategies that I use. Those really, really simple lessons that actually allowed me to buy stocks when I was 10, 11, 12 years old. I still take those to heart. I still use those on a daily basis. And I grew up playing sports, and all my coaches would always say, keep things simple. Keep it simple, stupid, was the KISS methodology. I take that to heart in my investing. I try to keep things as simple as possible. I don't believe that the most complex system actually yields any tangible benefit. I think that simple systems executed perfectly work. So that's kind of what I'm going to share with you today is how I try to keep it simple. So I've got 10 lessons to share with you, again, from a lifetime of investing. I've been actively investing on my own since I was 18 years old. I started trading my own account when I was 18. But throughout middle school and high school, I was actually investing alongside my father. So it is really kind of 15 years in the market. These are the 10 lessons, 10 most crucial lessons that I can pull. First and foremost, investing is a business. Woodworking is a hobby, investing is a business. It's your responsibility as an investor, as someone who's managing their own money, it's your responsibility to treat your investing as a business. I sort of like to say, treat yourself like the business that you would like to buy. I want that to stick with you. Treat your investing like a business. Now, one thing to note here too is that I'm talking to you as an individual investor. I'm managing my own money. I'm trading my own account. So what I'm trying to do on a daily basis, on a weekly basis, monthly basis, is take my investing as seriously as I can, treat it like a business, and sort of go from there. Implement strategies and routines and practices that any good business would use to operate. Lesson 2, buying is stage 7. Now this is in quotes here because this is actually, it comes directly from my book, Tensile Trading. Investing is about a lot more than just picking stocks. I see these people all the time that say, okay, I want to start managing my own money. I'm going to go buy some stocks and I'll figure out the rest later. I'm just going to go buy a couple stocks and see what happens. And then I'll try to put all the other foundational pieces in place later on. You're going about it the wrong way. What I'm going to show you in just a second is this kind of roadmap that we built that really defines our book, the 10 stages of stock market mastery. And the point there is that buying is actually stage 7 in our 10-stage roadmap. You need the foundations in place to set you up for successful trading. It's not about just diving in head first and saying, I'm gonna go pick a bunch of stocks and see what happens. You need to design and follow a system. And I'm gonna harp on this a little bit more as we continue on. You need to design and follow a system, not just start randomly throwing darts. So here's that roadmap that I mentioned. And as you can see, buying up here is stage 7. There are all these pieces in place that you have to go through. One of the big ones that we're going to talk about in just a minute is the investor self, really understanding your own psychology. But there are all these pieces that you have to go through, these stages that you have to go through before you actually start buying stocks. I firmly believe that. Buying is stage 7. So I mentioned this just a second ago. Lesson 3, have a system and write it down. This is arguably the biggest lesson of them all. If you walk away from one thing today, walk away with this. Embrace an investment approach that is appropriate for you. I see these people all the time. I talk to a lot of investment groups and seminars around the country and things like that, and through stock charts as well, get the opportunity to talk to a lot of investors, whether they're new or they've been investing for a long time. A lot of people jump into the markets and they say, I'm going to start trading options. And then I say, okay, whoa, back up for a second here. Why do you want to start trading options? And they say, well, I read this article in Forbes about this guy and he made a ton of money trading options. So I think I need to trade options. That's the wrong reason to get into trading options. If trading options is the wrong thing for you, it doesn't matter that it was the right thing for someone else. It's the wrong thing for you. What you need to find is an investment approach that is tailored to fit your specific needs, your interests, your timeframes, your objectives, something that's tailored to fit the true you, the realities of your life, the realities of your personality. The biggest component of that is understanding the true you. I actually studied psychology in college in addition to economics. And so I had this fascinating opportunity to learn about cognitive psychology, thinking, judgment, decision-making, how our brains actually work and process information. And it's incredible. We're going to talk about this a little bit later in the presentation. It's incredible how much your brain actually works against you, specifically as an investor. We'll come back to that. But understanding the true you and using that knowledge to build an investment system that's truly appropriate for you is massively important. And again, I put write it down up at the top. Write it down. I talk to all these people that say, yeah, I have a system. I don't really know what it is. I kind of forget it occasionally because it changes. It was different last week than it is this week, but it's a system. Yeah, no, it's a great system. It really works. I like to say that you find your edge in the market by crafting your system. You can build a system that will give you an edge in the market, and you find that edge by crafting your system. You sharpen that edge by fine-tuning and tailoring that system to better fit you over time. It can evolve. It doesn't have to be, totally decided from day one, from square one. You can evolve your system over time as you sort of learn more about yourself. You get deeper into the markets. You can fine-tune and tailor that system to sharpen your edge. But you still need a system and you need to document. What is a system? A system is intentional, it's describable, it's repeatable, and again, it's appropriate. Now, walking through all these really quickly, it's there for a reason. It's intentional. It's not someone else's system. It's your system. It's describable. You can write it down. If you can't write down your system, if you can't actually put it into words, write it down on a piece of paper and tack it up on your wall, your system is broken. It's not describable. It's repeatable. And a great benefit of technical analysis, I believe as firmly as I can, technical analysis allows you to build a system that is repeatable. It allows you to use the same indicators over and over and over and learn about them and build a system that can be repeated in the future. And again, it's appropriate for you. It makes sense for who you are. Now, my system, diving into it really quickly, as an investor, everything starts with appropriate climate. If the market's crashing, if we're looking at 2008, market's crashing, I'm not buying. That's fine. If the market's going down, I believe that a rising tide lifts all boats. A sinking tide sinks all boats, whatever the opposite of that is. Not a sinking tide. That was probably the wrong way to put that. But appropriate climate is the first thing. Strong technicals. I am a technician. I work here at Stock Charts. So technicals obviously play a big role in my investing strategy. Shorter term potential. I generally judge shorter term potential based on technicals. I'm looking for companies that are going to appreciate. They got new products coming to market. They got good things happening. And over 6 to 12 months, whatever it is, that company's going to grow. I look back in time, though, and I look at that company's decision-making history. I like to find companies that have a strong track record of great decision making. A good example of that is a company like Nike, maybe. Nike's been making great decisions about its products and how to grow and markets that it's going to enter and things that it's going to take on for a very long time. That gives me a lot of faith in trading or investing in Nike. And kind of building off of that, a longer term belief. So personally, there are segments of the market that I ignore just because I don't have a longer term belief in that segment or in that company, even if in the short term, they're doing really great. A good example maybe is something like cigarette companies. So there are times when cigarette companies start doing fantastic things. They're growing, great technical patterns developing on the chart. But over a longer term, I'm not so sure that cigarette companies are something that's going to keep growing. I don't think the long-term trend is in their favor. And so that's something that I actually steer clear of because I don't have that longer-term belief in those types of companies. As a technician, this is the interesting thing about today's presentation, because obviously we're on Stock Charts here, Stock Charts TV. My technical strategy really breaks down into 4 components: trend, relative strength, money flow, and momentum. Now, I've put up basically all the indicators that I use on my chart. I look at the same chart for every stock. I've got specific charts for equities, for stocks, for ETFs, for mutual funds. But talking about specifically the charts that I look at for stocks, I use a 20-period exponential moving average. I use a 50-period, 100-period, 200-period, and a 425-period simple moving average. Those are the moving averages that I use on my chart. Those are the moving averages that I have found help me determine trend. And then again, I'm looking at just sort of price developments. I'm annotating charts, drawing trend lines, and looking at what's happening on those charts. I employ relative strength strategies, not before trend, but they are a huge, huge component of what I do. And I'm going to dive in just a second here to something that I call the Fantastic Four, which is kind of explains the relative strength strategy that I use. In addition to that, I use Scooters. Scooters, the Stock Charts technical rank. Greg Schnell does a fantastic job talking about Scooters, explaining how to use them. The research that he's done on Scooters is fantastic. Follow Greg, learn about Scooters. They're an amazing relative strength tool. I look at money flow, primarily analyzing volume, Chaikin money flow, and on-balance volume. It's kind of a combination of those. Specifically on shorter term charts, actually. When I go to place a trade, I'm looking at 20-day, 1-minute charts and looking specifically, very specifically, at on-balance volume and how that's developing over a shorter term period. And finally, momentum. I use the PPO, sort of a modified version of the MACD, which is one of the most popular indicators out there, and RSI. So again, this presentation is kind of focused more on these 10 lessons, so I'm not diving into the technicals as specifically as I could. But I did want to put this up there and show you that my technical system breaks down into trend, relative strength, money flow, and momentum. I've got a very specific set of indicators that I use and tools that I use, and I use them repeatedly and consistently, always. Now, one of the most important things for me is something that I call the Fantastic Four. Hopefully I don't get sued for using that name here. We'll see. But under stock charts in the indicators panel, you can select price performance, and you can add these 4 blocks to your chart. Now, I've put up here the $ symbol to VTI, $ sector to VTI. Those are what you input into the price performance input. But explaining each of these, what I'm looking for from a relative strength perspective is the symbol versus the market. VTI is Vanguard Total Index. It represents the entire stock market. So that first bullet is the stock that I'm looking at versus the entire market. How is this stock performing relative to the entire market? If the stock is underperforming the market, I'm not going to buy it. If the stock is outperforming the market, I'm interested. That's what I'm looking for, is outperformance. Next is that stock belongs to a sector. So how is that stock sector performing relative to the market? I want to own a stock that's in a sector that's leading the market. Tom was talking earlier about technology and cyclicals. I love technology and cyclicals right now, and I want to own stocks that are in those sectors because they're driving the market higher. So dollar sign sector to VTI allows me to see how is this stock sector performing relative to the market. Now, drilling down one level into that is that stock's industry group. Within its sector, there's an industry group that it belongs to. And I want to own an industry group that's leading a sector that's leading the market. So I have dollar sign industry to dollar sign sector, and I get to chart that. Lastly, I have the stock, the symbol, versus its industry group. So work back up from the bottom. If you align all of these things and you sort of put them all, you've got, I'm going to show a chart here in just a second. You've got strong trends in all four of these little mini panels. You've got a stock that's outperforming its industry group, which is outperforming its sector, which is outperforming the market. That is four things lined up from a relative strength perspective that put the wins at your back, the wins of probability at your back, and the probability of that stock continuing to lead, continuing to climb and appreciate is dramatically improved. So that's what I'm looking for. On a chart, it looks something like this. I pulled up Netflix. We were talking about Netflix earlier. I've got these four panels on my chart. This is Netflix versus the stock market, represented by Vanguard Total Index, VTI. That's outperformance. Okay, so Netflix is outperforming the market. Now, Netflix belongs to the consumer discretionary sector. Again, another uptrend. So that sector is outperforming the market. Next up, you have its industry group, which again is outperforming its sector. And you have Netflix outperforming its industry group. All four of these lines are pointing up. You got a strong trend. You've got a strong trending stock. That's the stuff that I look for. Now, we're going to show this in just a minute. I loved a quote from Arthur the other day in a blog that he did. Expect trends to continue, not reverse. That really kind of defines my investing strategy. So we'll get into that a little bit more. Now we're going to really start to fly here. Lesson 4 is the investor self. It's your job to foster a keen and ongoing, that's an important point, understanding of what I call your investor self. The idea here is that successful investors know themselves. They know their strengths, they know their weaknesses, they know their advantages that they have, they know what gives them an edge in the market, they know their shortcomings, and they're not scared to acknowledge those things. They're brutally honest with themselves, and they use that self-awareness to their advantage. If they're not good at something, they understand how to work around that. They address it, they work around it. If they are good at something, they employ that in their investing strategy. They make use of that. It's your job to foster a keen and ongoing understanding of your investor self. Really get to know yourself. Now, I firmly believe this emotional control in investing in the markets is half the battle. I'm putting up this graphic here from our book that just goes over, this is a classic Wyckoff graphic actually, goes over all the market stages. And for each one, we've got these little emotions. These are the things that you're feeling as the market goes through its cycles: optimism, excitement, euphoria, anxiety, desperation, panic. You need to maintain your emotional control throughout all of these cycles. And if you look at the world's best traders, they're people that can sort of stay flat throughout all of this. They don't get horribly panicked and start to think about jumping off a cliff just because the market's crashing. They take action, they move forward with that knowledge, and they address their own emotions.
Hey, Grayson.
Yep.
You know, the one person that comes to mind when I was looking at that, as far as the emotions go?
Who?
Think about CNBC and who they brought on, to talk to during bear markets.
Yeah.
It's Warren Buffett.
Yeah.
I think Warren, throughout, the stock market can be falling apart, and Warren Buffett comes on and he's kind of that reassuring guy that says, this is a great opportunity, one of the greatest opportunities of our lifetime. I remember seeing that on CNBC back in 2009.
Absolutely. He's a picture of emotional control.
Yep.
And it's, I've always found it really interesting that if you read about Warren Buffett, he spends most of his day, I don't think he has a computer in his office. He spends most of his day, about 6 hours, reading, just taking in information, thinking. He's not on there selling everything in a panic because he sees, one candle on the chart and he gets scared. He is managing his own emotions. And that's what you need to succeed in the markets.
Can I ask you one question? Because you've gone far enough into this where I think maybe
Sure.
It's an appropriate question.
Yeah.
You disregard diversification?
Do I disregard diversification?
Yeah, I mean, you said you really like technology, you really like consumer discretionary, so obviously you're going to follow those trends. Do
Yeah,
you diversify into other areas just in case things go wrong, or
I do. I
follow
do.
the trends? Okay.
And that's unfortunately, you know, I'm pressed for time, so I couldn't cover that as thoroughly as I'd like to. But I have separate portfolios. That's actually an important thing to understand. I've got longer term, sort of what I call core portfolios that are, whether they're retirement accounts or they're just other investment accounts that I've intentionally made long term. Those are my core positions. They're well diversified. They're in stable things. I'm not looking at the charts on a daily basis. I'm not worrying about the candles. And then I've got a trading portfolio that I'm more actively managing, where I'm, you know, kind of aggressively moving into sectors of the market that are leading. So I do sort of maintain this high level of diversification, but it's in these other sort of more long-term, what I call core portfolios. And then my trading portfolio, which is where I'm employing a lot of these strategies that I'm talking about today, that's kind of what I call the explore portion of my total portfolio. But it's a totally separate account, actually. I literally have different investment accounts for the two. I've got a core, core portfolios that are over there, and I've got the explore portfolio that is totally separate that I'm actively managing. So I don't disregard, Tom, diversification. I do maintain a fairly high level of diversification. I'm looking at correlation values to pick those things. But it's kind of a different strategy, and it's more of a little bit more of a set it and forget it type of thing in a totally separate portfolio.
Okay.
So hopefully that answers it. Who knows? Maybe I'll come back on here and do a whole presentation about that. Give me a couple months though.
Sounds good.
Anyways, I'm gonna fly through here. Keep going a little bit. Cognitive biases. We're talking about emotional control. Cognitive biases are these innate tendencies of the human mind to think, judge, and behave in irrational ways, generally that violate sensible logic, sound reason, or good judgment. So again, I mentioned this. I studied psychology in college. I took a class. My favorite class in college was this class called Thinking, Judgment, and Decision Making. And we learned about all the ways that your brain completely tricks you. It does the wrong thing constantly. And when you apply those lessons to investing, the results are profound. You've got all of these innate tendencies that are driving you to incorrect decisions. And now that you know, I don't want that to scare anyone off, because I think that there's a way around this, which I'm going to share in just a second. But for example, one of the most common one is confirmation bias. The tendency to overweight, seek out, or more readily recall information in a way that confirms your preconceived beliefs, while simultaneously undervaluing or ignoring information that disproves our preconceived beliefs. Basically, you're going to look for stuff that confirms what you think you want to think, and you're going to ignore stuff that proves you wrong. You're going to confirm what you think, and you're more biased towards information that confirms that. So again, think about making an investment decision. You're looking at a stock, you think, you know, great things are happening on the chart, and then you hear some really bad stories. You look up the seasonality charts, you start maybe looking at the intraday charts, and there's some ugly things happening, but you really want to buy the stock. And so you're going to look for information that confirms, yes, this is a great trade, and you're going to simultaneously ignore stuff that says, hang on, maybe this isn't really what you want to be buying. So I'm going to direct you here in just a second to a chart school article, but why does this matter? These understanding these cognitive biases, they matter because the first step towards combating them, overcoming these effects, is just understanding them. If you understand that they're there, you've got them sort of in the back of your mind. Hey, am I falling victim to confirmation bias or the endowment effect? That's how you combat them. And again, their relevance to investing is profound. So what I want you to do is a little bit of homework here. Go read this article in Chart School. It's totally free. It's called Cognitive Biases. You can search the site for it. I actually wrote it a couple of years ago. But it's a great article that'll walk you through a lot of these cognitive biases and specifically the ones that are most relevant to investing. So I'd encourage you to go take a look at that. Lesson 5 here, I'm going to keep flying. Discipline. Impulsiveness is deadly to your financial well-being. I talk to a lot of people and you say, what's your investing system? And they say, well, my interest kind of comes and goes and I kind of just make decisions kind of haphazardly when my interest is at a high, and then I lose interest. I kind of ignore stuff, but I still own it. That's horrible. If you're making impulsive decisions, that is deadly. Your investing system is only as strong as your discipline to stick to it. You can have the world's greatest trading system. You can have the greatest rules, the best technical indicators. You can be set up for the right signals. But if you don't have the discipline to stick to that system, it doesn't matter. It doesn't matter how smart you are, how clever you are. Nothing matters if you don't have the discipline to stick to your investing system. I'm going to go out on a limb here. I've said this before in other presentations. I don't think that trading is that difficult. There's the dramatic pause there afterwards. With all of the tools, the resources, the educational resources, the commentary, the data, with everything that you have at your fingertips now, whether it's on your laptop or on your smartphone, all of the financial analysis tools that you have, I don't think that investing is that difficult. What it takes, though, is an incredible amount of discipline. So what makes trading so hard and what separates good traders, successful traders from not successful traders is discipline. Good traders have the discipline to stick to their system and execute it day in and day out, week in and week out. I think that is the difference. That's what makes investing hard, is maintaining the discipline and sort of having the emotional capacity to do this repeatedly over and over and over again. Routines and organization are how you execute discipline, how you maintain discipline. They're the key to consistency. And again, I've said this before with the system. It applies to routines as well. You need written routines. You have to write it down. A routine that's somewhere in the back of your head and it's kind of floating around and it might change and you might forget it. And I got 5 routines, but I can't remember the fourth one. What was the fourth one again? That's just junk. You need to write down your routines. You need to stay organized. Organization is absolutely integral. Good organization, good routines, they're going to put both time and money in your pocket. I have daily, weekly, monthly, and annual, but daily, weekly, and monthly routines that are written down. They're in a checklist format. And for example, every Sunday, I have my weekly routines that I go through. I sit down Sunday evening. I'm getting ready for the trading week coming up. And I go through the exact same set of routines and I literally check each one off. They're written down and I am going through and I'm checking off those routines to make sure, yep, I'm going to do this. Yep, I'm going to do that. Oh, I forgot to do this. Okay, yep, I'm going to do that now. I'm going to check it off. Written routines are crucial. Lesson 7, it pays to be an optimist. Now, we might have some arguments about here. And, if you're playing the short side of the market, that's fine. But for me personally, again, this is my investing system that I'm sharing with you today. Over the past 50 years, over the past 100 years, the optimists have outperformed the pessimists. Now, it depends on the time frame that you're looking at. But why? It's because the long-term trend of financial markets is up. I personally play the long side of the market. I do not play the short side. I don't short things. Because in my opinion, investing with a positive attitude, going to bed at night saying, yeah, I really hope that Netflix continues to grow. I hope their subscriber numbers go up. That'd be great. Investing with a positive attitude like that is more fulfilling to me than investing with a negative one. I don't like going to bed saying, I hope that company fails and a bunch of people lose their jobs, because then my short position is going to go up. If you're comfortable with that, if you like that, more power to you. Personally, I like to put the long-term trend of the market on my side and play the long side. Again, I said this earlier. I love this quote from Arthur. Expect trends to continue, not reverse. Really, at the end of the day, that defines my investing strategy. Simple systems that take advantage of trend and trends continuing. So again, look at 100 years of the Dow. It's up and to the right. The chart is up and to the right. Look at some of the crashes. I mean, this is a chart of 2 of the biggest crashes that we've had recently, and the market has recovered from both of them. So I like to put that long-term trend on my side and play the long side. I'm getting close to the end here. Ask what, not why. No one is paying you extra to answer the why. And I love to use the crash actually of 07, 08, 09. The market rewards investors who know what and pull the trigger, not those who ask why and they sit around and they're waiting on the sidelines until they find an answer. You take 2007, 2008, 2009, the complexities of the housing crisis and everything that was going on with the derivative products and everything, That took months, years, a decade maybe. I mean, I was studying in college and we were kind of still just starting to figure it out in 2014. That took so much time to figure out. And so everyone who was sitting around saying, wait, hang on, why is the market crashing? I'm not sure, the market's been going up for a while. I'm not sure why this is happening. I want to figure out why before I sell any of my positions. Bad strategy. What was happening in 07, 08, 09? The market was crashing. You pull the trigger, you get out, you ask why later. The why often takes months, years, decades to figure out. Again, look at these bear markets. What was happening here was the trend changed. It started going down and the market was crashing. Get out, pull the trigger. Act on the what, ask why later. Lesson 9, analysis paralysis. I wrote a blog, again, a little piece of homework here. I wrote a blog last week. It's kind of funny. I was getting messages from Julia saying, oh my God, that blog was awesome. That was so great. I really enjoyed your blog. Go read this blog. I'll put it up here in just a second. But analysis paralysis, no matter how much research you do, you're never going to have 100% of the information. So many people are absolutely crippled by this fear of not having complete information. They're crippled by analysis paralysis. They're paralyzed by this ongoing endless analysis, and they never pull the trigger. They never make a decision. They never act. On both the buy and the sell sides, if you're not acting, that's still a decision. Inaction is still a decision. A lot of people think, oh, if I don't take any action, that's or if I do take action, that's a decision. And if I just sit here and I kind of ignore it, I'm not making a decision. That's fine. Inaction is still a decision. You're choosing not to do anything. There's a great sort of insight that came out of Amazon. I think it was about a year ago. They said they, as an organization, they try to make decisions when they have 70% of the information available. That's a Bezos thing, a Bezosism. If you have 70% of the information available to you, you have enough to make a decision. You have to act, you have to go, you have to take a little bit of a leap of faith, and you have to do something. Again, here's that blog. It's from last week in the Traders Journal. You can go to stockcharts.com/journal. It'll send you over to the blog, but it's called Stop, Don't Touch It, Let It Go, Quit Tinkering. I get this a lot. The first thing that people ask is, hey, but what if you just change this, you modify that, you try it this way, maybe if you do this. No. I don't do that. I've got a system. I let it send me signals. I act on those signals. If they go the right way, great. I let those positions run. If they go the wrong way, that's fine. I learned a lesson and I get out. Simple. Last lesson, buy strength. Again, this is kind of building off of that idea of the long-term trend of the market, but catching a falling knife is nearly impossible. It's very, very, very difficult. And I'm tempted by it all the time. For example, Tom and I had arguments I guess it was a couple of years ago now, but about Chipotle. Is this the bottom in Chipotle? And that thing just kept falling. It would rally a little bit and it would fall back down. Rally a little bit and it would fall back down. Catching a falling knife is incredibly difficult. And like I said, I'm tempted by it all the time. But because I have this sort of rule in place, I steer clear of that. I'm trying to buy strength. I'm trying to buy growing companies that have strong trends, and I just try to ride that trend until it turns. The benefit of being an individual investor is that I'm never going to move the market, specifically when I'm buying mid-cap and large-cap stocks. I'm not a hedge fund. I never have positions that I have to carefully unload. I don't have to disclose anything. It's easy. If a trend changes and I'm holding the stock, I just sell the position. I get out. That's a benefit of being an individual investor. You're not going to move the market, so I can move very, very, very quickly. And that is a huge, huge difference between big institutional campaigns, big institutions, and the little guys like us. It's a tremendous advantage that we have. So again, don't discount leadership because you're too scared to be late to the party. I mean, I started watching NVIDIA when it was at $30. I haven't even looked at a chart of NVIDIA in a couple of weeks, but we're well over 200. We're up towards 300 on NVIDIA. And at $30, I remember looking at it saying, wow, this thing has run pretty far. And a lot of people were saying, it's gone too far, too fast. Don't discount leadership. Leadership and growing companies are growing for a reason, and they're leading for a reason. Don't be too scared to be late to the party. Key takeaways. We've got the 10 lessons in place now. Key takeaways. Find your edge and build your system. If you walk away with one thing from today, that's what I want you to leave with. Find your edge. build your system. Again, be the business that you'd want to buy. Treat your investing, take it seriously, treat it with the seriousness that it deserves, and act like the business that you would want to buy. Get to know yourself. Understand those cognitive biases that we talked about. Go read that article. Take some time to just be brutally honest with yourself and say, what am I good at? What am I bad at? How do those affect me in the market? Lastly, ask what, take action, and get moving. Go out there and learn. If you take a loss, I've said this a lot in past seminars and courses and things like that. If you take a loss and you learn a lesson from that, all you've done is paid tuition to the market. You've paid tuition to the market to teach you something. And if you extract that lesson, you learn from it, and you apply it in the future, and you don't make that mistake again, then that's fine. You know, you pay to go to college, you pay the market to teach you some lessons. If you take a loss and you ignore it and you just say, that was terrible, I made the right decision, but something else happened, then it becomes truly a loss. Ask what, take action, get moving, go learn something. Go learn about yourself, go learn about the market, get moving. Lastly, I got my book up here. If any of this kind of resonates with you, I would encourage you to go buy the book. I think you'll enjoy it. And you can also visit our website there at Stock Market Mastery. I think, if you join our mailing list, we've got an online course that we're hoping to develop in the next couple of months. So we'll keep you informed on that. But other than that, thanks for having me, guys.
Really fun. Grayson, that was a great presentation. And I know there are a lot of questions in the chat room. So I think Erin's going to summarize a couple of questions for you.
Sure. I know I went long, so let's hit those quick.
Yeah, no problem. One of the big ones, of course, is do you have a scan that you use for that Fantastic Four that you talked about earlier?
You know, I don't. One thing that I do have is alerts set up for specific scooter levels. So I actually have a scooter crosses 80, scooter crosses 85, scooter crosses 90, and scooter crosses 98 for large cap and mid cap groups. And I get those alerts every day. They get sent to me every day. So I get to kind of watch the scooter lists. The tool that I use instead of scans for that sort of Fantastic Four thing, I use the sector summary. Tom has done a fantastic job. You're always showcasing that thing. If you look back at, like, let's say 3 months or maybe 1 month, depending on your time frame, or longer, and you start with the sectors, you take one of the top 2, you click into that, you take one of the top couple industry groups from that sector, you click into that, then you sort it by scooter. Maybe look at whatever group you want to look at if you're primarily looking at large cap or mid cap or something like that, and then you click on the stock that's leading, sort of drilling down into the sector summary thing. It's incredible. You'll find those Fantastic Four charts. So that's kind of how I do it, actually. I don't use a scan. I just use the sector summary page. It works pretty much just as well.
All right. And your chart style, is that available if they go into the blog? Would they be able to copy a chart to get some of the chart styles that you use with those moving averages?
Yeah, you should be able to. There is actually the Grayson Roze chart style, which has, if you want to go and grab your if you're a Stock Charts member and you want to go grab the Fantastic Four charts, you can do that from the Grayson Roze chart style. I think I might have to go upstairs here in a minute and say, Chip, I need a chart style in the workbench.
Yes, I think you do. The rest of them, I don't know if you'll have time to go peek into the chat room, but there was definitely questions about, how often you trade, stop losses, that sort of thing. So if you have a few minutes, they'd really appreciate those answers.
Sure. I'll try to go jump in there.
Excellent.
Great presentation. I know you did a lot of homework putting all this together for everybody, Grayson. I really appreciate it. Really some super lessons for everybody, certainly as they look at their own investing strategies. Yeah. And I would just say I've also told people I think it's a good idea to write things down, and you really stress that a number of times because you don't really get the sense of whether or not you're following your system unless you really go back and write it down and check it out.
Yeah, absolutely.
Awesome. Great job.
All right, guys. Take care.
It was great having you. At this point, we're getting a little bit of a late start, so you'll just have to fly through those 10 and 10 stocks.
Ready.
All right. I I won't show you the RRG. We did have 35 requests. Everybody in the chat room, go like the symbols that you would like to see reviewed. The most popular will definitely make the second symbol for the 10 and 10. So let's go ahead and get started with Constellation Brands.
Okay, STZ, I think it's in a great uptrend. I think it depends on whether you're looking at it from a long-term or short-term perspective. Long-term, great uptrend. Short-term, we're at resistance.
Okay. All right, let's look at what the most popular one is in the chat room right now, and that would be PayPal.
All right, PayPal. It's another one that's right up against resistance. I think this is a great continuation pattern off of an uptrend. So if you take a look at the key resistance area, we're trying to make a breakout. Volume is okay today. I'd like to see that pick up, especially if we get a close up near the high of the day today. But this is pretty significant because after gapping up back in October, our reaction lows have been down around that $70. Highs have been around 85, 85 and a half. Trying to make that breakout today. I think PayPal looks good.
All right. Next one I have for you is going to be EWZ. That is the iShares Brazil ETF.
Yeah, keep in mind, too, that the rising dollar is having a negative impact on some of these ETFs, international ETFs. They may not be doing nearly as well as their underlying index, and it's because of that strength in the dollar. Because of the dollar, I think that international ETFs are a problem, and clearly you can see that we have been downtrending. I think this gets back a little bit to what Grayson was just talking about. I mean, if you're keeping it simple and you're looking at this is a pretty serious downtrend. I'm not going to try to predict the reversal here just yet, so I would steer clear.
Okay. Next one for our Canadian friends, I have CNR.TO, which is the Canadian National Railway.
Yeah, I love the railroads, and I think this is a beautiful breakout here. There is a negative divergence in play, so let's first just check out the breakout, which you can see the top back last year. We cleared that. Nice volume coming in on that breakout. We do have a negative divergence, so if you connect the recent price highs with the PPO rolling over, you can see that right here and right here. So you got higher prices, lower PPO. That could set up a possible 50-period test and a centerline test. We seem to be moving in that direction. So what I would be looking for is that centerline test, eventually a 50-period test. But what we might see is just sideways consolidation, allowing that 50 to come up from underneath. I like the chart. I think short term we could have some momentum issues. Longer term, I think it goes higher.
All right. Next one, also popular in the chat room, was Solar Edge, SEDG.
Yeah, Solar Edge has been a really good stock. I don't like the fact now that it is failing at the 20-day moving average on rallies. So I'd like to see that change, and also the fact that it just lost some recent price support. But there was your failure at the 20. Now we're coming up trying again. Look at the volume. It's been very heavy on the selling. So I'm going to say be a little careful, a little cautious here. We had nice support around 50. We broke down below on heavy volume. Now we're coming up and testing the 50 level again. I think this one could potentially maybe even drop down to about 42 to test the top of gap support. So for me right now, the trading range is 42 to the downside and maybe that 20-day moving average, which is up close to 53.
All righty. Let's do after Sedge Watt, WATT. That's in telecom equipment industry.
All right, another one that's just been trending lower here for a while, but I love that huge move up on heavy volume. So after this consolidation, I actually expect that maybe we'll see some, a little bit more bullish action here on Watt. I would probably watch this trend line coming across here. I think if we can get back through the moving averages and break that trend line and see the volume start to pick up. Volume's been very light lately. I think if the volume starts to pick up, that will be your sign maybe that uptrend, or at least that surge that we saw back at the end of the year, is resuming.
All right. How about Facebook?
Yeah, Facebook I touched on earlier. It is breaking out above $200 for the first time in its history. It has cleared the February high, which was an important area to clear as well. And the internet stocks are doing extremely well. But 195 was the high back in February. We worked up to 195, pulled back, hit that rising 20, and we have taken off. If there's one negative on Facebook's chart, the volume is a little suspicious, and we have a negative divergence. So if we don't hold 195 going forward, I would be very careful. I'd keep a stop around that 195, maybe down to the 20-day moving average, which is just a little bit below the 195 level.
Okay. How about our only consumer staples stock today, Walgreens, WBA?
Okay, another one that's downtrending, trying to make a break out of the downtrend, which is encouraging. It's part of a group that's not doing particularly well in the consumer staples area, but it is part of the drug retailers, which is having that group is really doing well today. So I think that's part of what's going on. I'm going to just kind of draw this trend line right in here. You can see we made a little bit of a break with volume last week, went down, tested the 20-day and breaking back up. PPO looks good. I would say that if this truly is turning, that rising 20-day moving average should be great support on any pullback.
Okay, let's go on to Citibank, or Citigroup, I should say, C.
Yeah, C is part of the larger money center banks, not doing nearly as well as, say, the regional banks. So if I was getting into banking, this would not be the stock or the group necessarily that I'd be looking at right now. I would continue to watch maybe the recent highs. I think you've got a trend line that's in play there. We could almost grab that, maybe from these lows. Looks like we've got a channel that's been going. Let's break that channel to the upside before getting excited about Citigroup. In the meantime, stick with what's working in the banking space, and that's regional banks. The ticker symbol for the ETF is KRE.
Okay, and our final one, AKAO. I'm not going to try and pronounce the name of the company.
Yeah, that just by the name of the ticker symbol, I'm probably not going to try. I'll go with Acogen. How's that?
Yes, and then nice breakout there, and I do have a PMO buy signal just came in.
Yeah, I think on this one, we might have gotten an exhaustive gap to the downside. Very heavy volume. We gapped down after making this push, but notice we didn't take out the prior lows. I think we are consolidating. I think this is the range that you need to pay attention to. I think if we break back up above that 15 level with increasing volume, I think that confirms the exhaustive gap and the reversal of trend.
All right. And that concludes the 10 and 10. Man, Tom, you just did awesome. I think it was 7 minutes.
I tried.
Yeah, that was awesome. I think it's the shortest yet. Here are the symbols that we covered today for the 10 and 10. I will have those up in the Market Watchers Live blog and recap if you want to go and copy those charts from our live chart list. And with that, we'll be right back after this message.
Volatility is back and interest rates are rising. With the markets headed into uncharted waters, ChartCon 2018 is here just in time. See how the experts are protecting themselves and watch live from the comfort of your home or office as they reveal the risk management strategies they use to stay profitable in any market. Plus, you'll get complete video recordings to watch on demand for years to come. Join us at ChartCon 2018, streaming live August 10th and 11th.
All right, it is time for our final market update for the day. Looking at 3-day charts, these are the 10-minute bar charts, gives us a good idea of what's going on. Dow is floundering, gap down yesterday, and now we're choppy trading sideways across. However, we are up right now, just slightly. S&P is now getting close to hit. It's testing those highs that we saw back on June 18th. So that could be an interesting breakout there. NASDAQ gap up, continuing higher. We have the mid caps and the small caps doing quite well at this point. We also are seeing the TSX had a gap up and it is also heading higher. TNX treasury yields, as Tom covered at the beginning of the show, are up right now, currently 2.91%. 92%. Commodities lower on the day. They did gap up and it looked like we were going to be on the positive side, but have come back down and are tested the intraday low from yesterday. UUP, choppy sideways trading since yesterday's gap up only slightly, 25.05, 1 cent. We can see that USO has, it started off with a great day. It hit some intraday highs around 13.45. But has just dropped like a rock over the past hour or so, and currently still on the positive side, reading 13.22 for USO. Gold is down slightly, not a surprise when we saw that the dollar is slightly up. And right now, the volatility index is falling. People are getting a bit more comfortable with what is going on currently. And I'm going to close off our final market update. And let's go ahead and get started with our final segment, watch list. And Tom, why don't you go ahead and discuss it, and I will get my charts all ready.
All right, sounds good. Yeah, what we're going to do with watch list, it's a new segment, and really just going to highlight some areas, some of the things that Erin and I are looking at in the market. I know for me personally, I don't own any of the things I'll be talking about, but there's certainly areas that I'll be looking to possibly trade. And so just an idea, just giving you some ideas, maybe some trade ideas on some things maybe to keep an eye on as we go forward.
Absolutely. So I put together a watch list. I'll just go through mine very quickly. I found some of these through my own scans. I found some using, let's see, the parabolic SAR predefined scan gave me some ideas. So these are all some of the ones I was looking at as possible investments a little bit later on. So let's go through, and I'm going to show you. There we go. Hopefully you can see that a little bit better. So I'm going to start with Amerisource Bergen Corp, ABC. I just got these, look at you can see it really well in the thumbnail, but I just am getting that 5,200-day EMA positive crossover. So that will be putting ABC into a bull market configuration. And you can see the 20's already gone above that 50. I see this flag, and it stopped at the top right here at this overhead resistance. So for me, I'm leaving it on my watch list because I want to see the breakout and see that flag start to execute, possibly even wait for that $95 range to be successfully tested. I'd like to see that move over. But you can see OBV volume is moving up nicely, and the scooter is starting to make its way back up. Next one I'll show you is AutoZone Nevada, AZO. And you'll note some of these have rather low volume, so just be aware of the volatility that might be inherent just because of the fact they're low volume. Also got a 5,200-day EMA positive crossover. Again, new bull market configuration. Already had that 2050 crossover earlier in June. And then we have this beautiful flag formation. It's in this trading zone. But notice if you go here in that thumbnail, we are seeing a bit of a breakout today in the very short term. And I think that is positive, but I would like to see it break out just a little bit more. I'm not going to need a decisive breakout necessarily of a 3% move, but I would like to see that flag start to execute. You can see how long that flagpole is, and coincidentally, or maybe not coincidentally, if you add the size of the flagpole onto where the breakout area would be, it's going to test those highs back from January. Let's see, next one, Drillquip. I thought this one was interesting. Also got the 5,200-day EMA positive crossover. You know, PMO, you'll see that a lot of these, the PMOs already had the buy signal, and it has been in an upward movement. A lot of these stocks might look like that. But I picked them because I am starting to see this long-term change. And I think there's pretty good upside potential on all of these. So that's why I'm looking at them. With this one, you can see we got that breakout, but it's still not quite out of this consolidation zone area of support here from these tops across. I think we're going to get a move at least up to that 52 to test the top of this range. If I get a pullback, honestly, within this range, I might go ahead and get in just to get that move from 50 up to $52. And if we can get that breakout, I'd be looking at these highs here at $56. Let's see, Genesco. This was another one I liked. And actually, I think I did end up buying this one this morning, just FYI. I do have a PMO that is now turning up, and those are the ones I actually like to get into. I see a breakout here. So this has actually been on a watch list. And so when I saw the breakout, it's not, I mean, it's just above here at 42, but I like this setup that, you know, you could almost make a case for, you know, you've got these nice rising bottoms coming up. We're now breaking out above that $42 level. You can see the 20 is turning back up to cross above the 50. And we already have a bull market configuration that started for us back here at the beginning of March. OBV, it's doing pretty good here. You know, I would have liked to have seen these two bottoms here be rising rather than still and mostly sideways, but I still thought the pattern looked pretty good, and my upside potential here, even if we just stay in this trading range up here, I still am going to get a move up to 46, and at least that's what I'm anticipating. Probably would set my stop, you know, down here at that $40, somewhere in the $40, $40.50 range. That's kind of my mental stop right now, depending on how this breakout moves itself. Yes, I did end up, and I don't know if you saw in that summary, with two apparel retailers, which I found interesting. You can see the PMO is turning up above the zero line, so that is positive. You've got OBV trending higher, scooters in that hot zone. And again, we've got a little bit of a trading range here. So I might wait until it gets back down to take advantage of this trading range. Or, you know, if we can see this particular breakout, again, you can see in the very short term, if we can see it close above that previous, you know, if we can get a positive close today, I might consider it. But at this point, really what I'm watching for is just a little bit of a pullback here so I can take advantage of this trading zone. If I get a breakout, I can take advantage of a move up to $26. Cario Farm. I believe this one is in healthcare. I can't remember exactly, but I've got the breakout. You've got a double bottom. If I did this in a solid line chart, I think you would see it a little bit better. The height of this pattern would get us up to about $21. So we would expect a breakout from this high up here. So I thought this one looked very interesting. And again, this is the kind of setup on the PMO I like to see. This is what comes up in my scans. I want to see not quite the crossover, trying to anticipate it just a bit, but to see a nice move where we're getting 2-3 days of upside on the PMO, I think is very, very positive. And final, I will pass it back to you, Tom, after this one. Nice flag formation here. PMO is now above that zero line. It is not overbought. There's certainly room for it to move higher. And again, I really like this flag formation. It's taking a little bit long to execute it. You know, I prefer my flags to not be quite so long. But I think with this 20-50-day EMA positive crossover, you can see things are starting to clear up a bit. You know, Scooter is still healthy. So those are the ones that are on my watch list right now. Tom, what do you have on your watch list these days?
Okay, well, I'm going to focus on a group. And I mentioned it at the top of the show, broadcasting and entertainment stocks. First, I have a long-term chart up here that goes back since really the turn of the century. And you can see, first of all, that this is a group that has the potential and certainly has in the past made huge runs to the upside. We saw this from really the 2009 bottom all the way up through about the middle part of 2015. Well, broadcasting and entertainment stocks right now are sitting very little unchanged from where they were back in the summer of 2015. So we had some down period and we had the up period, false breakout, came back down. But literally over the last 3 years, we've been going sideways. And what that means is that over these past few years, this group has been underperforming the S&P 500 by quite a bit, while its sector, consumer discretionary group, continues to outperform. So money is coming into this group. So the question then becomes, when does the broadcasting and entertainment group begin to outperform the consumer discretionary? It hasn't done that yet. But I see some positives here in the short term. You can't end a long-term downtrend until you end the short-term downtrend. And it appears to me like the group has ended the short-term downtrend that we saw since the late 2018 high. Remember, this high right here was an all-time high on the broadcasting and entertainment index. So the fact that the short term has ended, I believe we could be in a period where we could start to outperform not only the overall market, but maybe even consumer discretionary, the sector in general. So to the downside, what I would watch, because we do know the longer term is more sideways, I want to make sure that the short-term trend remains in play. So to the upside here, as we're climbing, any pullbacks, I would be watching the 20-day moving average. But given the volume, given the breakout, the downtrend, the end of the downtrend, the rising PPO above the center line, I think short-term momentum is really starting to build in broadcasting and entertainment. So I'm going to focus on individual stocks within this space. But again, keep in mind, watch the index. If the index starts to break down, then I would be really careful with the individual stocks. And certainly if the individual stocks start to break down, be careful. Pandora, after gapping down on massive volume back in November, sideways consolidated for months. And then finally, we got the gap up. We've gone through gap resistance and are pointing up. I think that Pandora here looks very solid. ENT, I'm going to bring these all up in the relevant chart style. But ENT, Global Eagle Entertainment, look at the move here. It was under $1 a month ago. Now it's $3. I know a number of you out there like these small stocks. I would just be careful because this $2.75 to $3 area is where we have failed in the past. But what would be interesting to me maybe is to look at the volume coming in, by the way. So if we get a pullback, we've got some pretty good support between 2.25 and 250 with that rising 20-day moving average in that area as well. So keep an eye on that 225 to 250 area on a pullback. Sirius XM. This has been a really strong performer. We broke out again at the beginning of May, taking out that March high. We have been performing exceptionally well relative. Well, here's the broadcasting entertainment, but here is Siri relative to the broadcasting and entertainment group. Very strong action. Here, the S&P 500, we compare very favorably there. And the broadcasting group here in June is starting to show strength. So if this short-term strength continues, and again, I can't emphasize this enough, we want to make sure it continues. Sirius is a great candidate within this space. All right, AMCX. AMC Networks, another stock. Look at the volume here in June coming into the stock as it makes a breakout above prior highs. Again, it's overbought. I'd need to see a pullback maybe to that rising 20-day moving average, but volume trends have changed, and you can see AMCX relative to broadcasters, very strong. So if the group begins to or continues improving, you'd have to think that this is a stock to certainly keep in mind. Let's keep going. Just a couple more here. EROS. This is Eros International. The reason I pointed this one out, look at the overhead resistance here. We keep failing right at about $14. Today, we're getting back over that 14 level. If we go back here, over the last year or so, the September high got up close to 17. I think if we get a definitive breakout above this prior high with the rising 20-day holding, this is a stock that could make a run for $17. So this is a possible breakout candidate or a pullback down to that rising 20-day. Again, volume trends have turned much more positive here on EROS. Disney. Disney is obviously one of my favorites just because it's a much safer company. It's a bigger company. I love the volume, though, that came in on this breakout above the May high. I think that is very strong. Pullback the last couple of days, last few days. I think if we get the 20-day test, you're going to hit that just about the same time as you hit price support around 105. And one thing I wanted to bring up here on Disney, let's take a look at Disney's weekly chart and go back a ways. I'm going to go back over the bull market over the last 10 years. Disney is in a very significant bullish continuation pattern. Very strong move from 2011 through 2015. There's your uptrend. Sideways consolidating for the last 3 years. This is why the group as a whole has not been able to break out. Disney won't allow it because it's not breaking out. 115 to 120. I'm going to shorten the chart so we can take a look at that. Let's go 5 years. I think we'll be able to see the resistance a little bit better on a 5-year chart. Here's this one level, 116, maybe 117 coming across. If we can get a breakout on Disney above 116, 117 with some increasing volume after 3 years of consolidation following an uptrend, I think this could be very, very significant going forward. So Disney is definitely a stock I would keep on a watch list. And then the last stock I had was Avid. And this one's a little riskier. The scooter's not as strong. The reason I think it's riskier is it's been in a downtrend. It's trying to reverse. But check out when it broke down back at the beginning of February, below some prior lows at around 5.5 or so. These reaction highs have been back up to about 540, 550. We haven't been able to get through. Volume starting to pick up. If there's one downside for me, it's the volume, the level of the volume. It's kind of borderline whether or not I would trade it, because it looks like it averages maybe a couple 100,000 a day, which is on the bottom end of what I like to see. But I do think a breakout, especially above 550, would be bullish. So those were the watch list stocks for me. Here is a summary of what Erin and I just went over. I've really focused just on the broadcasting group, some of the stocks that I'm watching pretty closely. I really like Pandora in that group. And then Erin gave you a number of different stocks from varied industries based on a scan that she ran.
Absolutely. And I do want to correct it. I didn't pick up GCO. I was looking at GES, Guess, an apparel retailer. Looked like it's setting up for a good trading range. So I just wanted to mention that in case people went to go jump into GCO right away.
Yeah, I do want to also, and by the way, Guess is in a great area of the market with the apparel retailers doing so well. I mean, this
Exactly.
is an incredibly strong month for apparel retail and for retail in general. And speaking of general, can't help but finish talking, just describing the GE
Yes.
today. The general of all generals, General Electric, after more than 100 years being included in the Dow Jones Industrial Average, it is being removed. And the reason for it, well, I think if we pull up a monthly 15-year chart here, probably have a pretty good idea. Look at the decline the stock has seen in the past 18 months. I mean, really, for a Dow stock, except maybe for what GE did back in 2007, 2008, this kind of a move in a Dow stock really is unprecedented, losing, 60% of the value of the company in 18 months?
Yes.
You think small cap stocks might do that, but you don't expect Dow components to do it. And I'm sure that's the reason why.
Yeah, certainly not one that's been in there, I think, since the late 1800s or something, 1895, I thought I read somewhere.
Yeah, it's been a long time. I don't know the exact number.
Exactly.
It's been a long time. But GE, I'm sure on your PMO is not looking too good on the longer term weekly chart. We did see, a little bit of strength. We talked about this not too long ago when we had on the daily chart, saw a little bit of a breakout, or what appeared to be a breakout, maybe of a bottoming head and shoulder pattern. But that should, when you get that, you should hold on to price support or that rising 20-day. We did not. We haven't been able to get above the 20. And now you can see the volume picking up again as we threaten the support that was established in March, April. So doesn't look good to me.
No, I'm out.
And then, of course, I don't know if you have any opinion on Starbucks. I'm going to go ahead and pull that one up. They did come out and warn about Q3 and their fiscal year, lowering their sales guidance, their earnings guidance. And you can see that the traders are not in a forgiving mood with Starbucks today, taking the stock to a new low here in 2018.
Yeah, it's pretty ugly.
Yeah, I was just going to say, any final thoughts on Starbucks?
Yeah, I did get PMO sell signal, of course, came in under the, beneath the zero line, and it, of course, is heading straight down with this particular trading day. But yeah, not looking good, and passing up that area of support too from back in February with one day. It's brutal.
Yep, brutal day for Starbucks, brutal day for GE. Here's our upcoming schedule for the balance of this week and into next week. Another great show, Erin. Really appreciate everybody being with us here.
Yeah, great time.
All right. Please remember to complete that survey as you exit. We do love to get your feedback, hear what you think of Market Watchers Live. Market Watchers Live airs 5 days a week, Mondays through Fridays from noon to 1:30 p.m. Eastern Standard Time. Have a great Wednesday afternoon, everybody, and we'll see you back here tomorrow. Happy trading.
Volatility is back and interest rates are rising. With the markets headed into uncharted waters, ChartCon 2018 is here just in time. See how the experts are protecting themselves and watch live from the comfort of your home or office as they reveal the risk management strategies they use to stay profitable in any market. Plus, you'll get complete video recordings to watch on demand for years to come. Join us at ChartCon 2018, streaming live August 10th and 11th.